Okay, so hello everyone, and welcome to day 3 of this ACCA AFM P4 Advanced Financial Management webinar conducted by ACCA. We have already had 2 sessions, yesterday and day before yesterday. So as far as day 1 was concerned, we covered investment appraisal question. Okay. As far as day 2 is concerned, we covered currency risk management. 3 techniques were covered: futures, options, and forward exchange contract. Okay. And today, as per the schedule, our topic would be interest rate risk management. Okay, we will study how to deal with interest rate risk. Okay, like yesterday our objective was how to deal with currency risk. Today our objective is to deal with interest rate risk. Okay. So basically I want you all to get a detailed idea before starting interest rate risk management that what exactly is interest rate risk. Write down the definition of interest rate risk so that we can start. Okay, so remember yesterday when we discussed with you the currency risk management. So the first thing which I taught you is that what exactly currency risk is. So remember the definition of currency risk from yesterday's class, that currency risk is the risk that currency rates may go up if you have to pay someone in future, or currency rates may go down if you have to receive money in future. That was currency risk, and then we studied how to manage it. Similarly, what is interest rate risk? Okay, so basically interest rate risk is also the same risk like currency risk. It arises due to movement in currency rates. We all know that currency rates don't remain stable, they move. Similarly, interest rates also keep on changing. You will never witness that interest rates are constant forever. They change, they move, sometimes they go up, sometimes they go down. So because of movement in currency rates, the currency risk arises. Similarly, because of movements in interest rates, the interest rate risk rises. Like, note the definition. Interest rate is a risk that interest rates may go up if we have to borrow money in future. Currency risk was the risk that currency rates may go up if you have to make payment. Interest rate risk is the risk that interest rates will go up if you have to borrow money in future. You plan to borrow money from the bank in future. There's always a risk that that time rates may go up. Or it is the risk that interest rates will go down if we have to deposit money in future. You plan to deposit some money in future. There's always a risk that rates may go up. Like, for example, today is 1st November, for example, and you plan to borrow money from bank in January. You would always have this fear in mind that till January the interest rates may go up. That is what interest rate risk is, that the risk that rates may go up. Similarly, today is, let's suppose, 1st November, and you plan to deposit $5,000 in Feb. So today is 1st November, you plan to deposit 5,000 Feb in future. There's always a risk or fear in mind that interest rates may fall, deposit rates may fall. That is what interest rate risk is. So interest rate risk is the risk that interest rates go up if you have to borrow, or interest rates go down if you have to deposit. Now, like currency risk, this can also never be eliminated. It can only be managed, and interest rate risk is also managed through use of some hedging techniques, right? Like currency risk cannot be eliminated. Similarly, interest rate risk can also not be eliminated. It can only be managed or minimized. So interest rates can be managed or minimized through the use of some hedging techniques. Okay, interest rates can be managed or minimized through the use of some hedging techniques. The hedging techniques don't eliminate risk. Like currency risk was also managed through some hedging techniques. So interest rate risk is also managed through some hedging techniques. And the most commonly used hedging techniques to manage interest rate risk are FRAs, forward rate agreements, interest rate futures, and interest rate options. Okay, again, there can be other techniques, but we will be discussing the most commonly used techniques. So the most commonly used hedging techniques to manage interest rate risk are FRAs, forward rate agreements, futures, and options. Like yesterday, I will tell you about individually each technique, what is FRA, what is futures, what is options, and tell you my easy formats of how to do FRAs, futures, and options. Once we are done with all three techniques, then we will do a past paper question, past exam question, so that you get an idea about all these three techniques. Okay, so till now we have discussed two things. Interest rate is the risk that interest rates may go up if you have to borrow money in future, or interest rates may go down if you have to deposit money in future. And it is managed through the use of some hedging techniques. The most commonly used hedging techniques are FRAs, futures, and options. Okay, so the first technique to manage interest rate risk, is called FRAs, forward rate agreements. Now you can consider FRAs is almost same as forward exchange contract. FRAs is almost same as forward exchange contract. Now, what do we do in forward exchange contract? In forward exchange contract, we are afraid that currency rates may go up, currency rates may go down. So we fix an exchange rate, right? What do we do in forward exchange contract? We fix an exchange rate. Similarly, in FRAs, what is the risk in interest rate risk? The interest rates may go up, the interest rates may go down. In FRAs, we fix an interest rate. FRAs and forward exchange contract both are contracts of rate fixation, but one forward exchange contract is used in currencies. FRAs forward rate agreements is used in interest rate. Do the same thing. You fix an exchange rate there, you fix an interest rate. Like for example, you plan to borrow 5,000 in January. After 2 months, you plan to borrow 5,000. There's always a risk that interest rates may go up. Fix a rate. Go to the bank, enter into a FRA. Okay, we will fix the rate at 10%. And whatever the rate in the market is in January, you will still be getting it 10%. This is the FRA. Similarly, you plan to deposit $3,000 in Feb. What is the risk? The rates may go down. You fix a rate. Okay, let's fix a rate. Enter into a contract forward rate agreement, 8%. The rate is fixed at 8%, no matter whatever the rate is, whatever falls down, you'll still get 8%. This is the FRA. Okay, now how to deal FRA in the exam? Now, how to deal with FRA in the exam? The format of FRA, it's in front of you. The format of FRA is in front of you. And if you want, I will send this format on here after the class or on your WhatsApp group. Okay, whatever. The format of FRA is that you need to take actual return on deposit or actual cost on borrowing, right? Actual return on deposit or actual cost on borrowing. I don't know, maybe the question gives you a payment case, maybe the question gives you a receipt case, we cannot guarantee. Like in currencies, sometimes you get a payment case, sometimes you get a receipt case. Here also in interest rates, sometimes you may get a borrowing case, you may get a deposit case. So you need to record the actual return on deposit or actual cost of borrowing. Okay, how is that computed? There's a formula: amount into rate of interest actual into time period over 12. And then you need to add or less benefit or loss due to FRA. How do you get benefit or loss due to FRA? It's different in interest rates, what is in the market and what was the FRA rate committed. The difference in interest rate means what was in the market and what was the FRA rate committed, into amount into time period over. Add or less benefit or loss due to FRA, you get net cost or net return. Now, why I have written add or less benefit or cost due to FRA? Benefit is sometimes added or deducted. Loss is sometimes added or deducted. Like for example, in the numerator, you got a borrowing case. You got a borrowing case. So firstly, you wrote actual cost of borrowing. Through this formula, you wrote actual cost of borrowing. Okay, let's suppose you got a borrowing case. So through the formula, you found actual cost of borrowing. Then you notice that you get benefit due to FRA. You got a benefit due to FRA. Will it be added or deducted? No. You know, benefit will reduce cost. Benefit will reduce cost, so we will deduct it. But let's suppose you get a case of deposit. So firstly, you will record actual return on deposit through this formula, actual return on deposit. And then let's suppose you get benefit. You have written return on deposit here. So benefit is likely to increase return, therefore we add it. I have written both things, add less benefit or loss. Why am I adding or deducting? It depends on the case. If it's actual cost of borrowing, and then you get benefit, so benefit will reduce cost, we will deduct benefit. But if it's a deposit case, you wrote actual return on deposit and then benefit, so benefit will increase return, therefore added. Similarly, let's suppose you have a case of borrowing. So you will firstly record actual cost of borrowing, and then you find that you got loss due to FRA. It can be added, it can be deducted. Now you have written actual cost of borrowing, and then you get loss. Loss increases cost, therefore added. But let's suppose you get a deposit case. So you will firstly write actual return on deposit, and then you noted that FRA gave you loss. So what to do with loss? Now here you have written return in the above statement, you have written return. So loss is likely to reduce your return, therefore deducted. So that's why it's mentioned add less benefit or loss, because it can be added as well, it can be deducted as well. If the case is of borrowing, we will write actual cost of borrowing through this formula. If it's a benefit, benefit reduces cost, therefore deducted, but it's a loss, loss increases cost, therefore added. But if we get to deposit case, we will write actual return on deposit, and then we got benefit, benefit increases return, added. But if you have loss, loss reduces return, therefore deducted. Okay, this is the format of FRA. Any questions regarding FRA? So you have to show the benefit or loss to gain marks, else you will lose marks. Okay. So I will repeat it again because one or two students are requesting that. See, in FRA, you either will get a deposit case or a borrowing case. So you firstly record actual cost of borrowing or actual return on deposit. If it's a deposit case, actual return on deposit. If it's a cost, you write, borrowing case, you write actual cost on borrowing, because if it's a deposit case, you get return on deposit. If it's a borrowing case, you get a cost on borrowing. Then add less benefit or loss due to FRA. Students see that why will we add or less benefit or loss? Now benefit can be added, benefit can be deducted, it depends on the case. Let's suppose your case is of borrowing. So you will write what? Actual cost of borrowing, because borrowing gives cost. And then you get benefit. What to do with the benefit? You know, you have written cost above. So benefit means benefit is likely to reduce cost, therefore deducted. But let's suppose you have a case of deposit. So you'll firstly write return on deposit. What you will write first? Return on deposit. Okay. If you will write return on deposit, and then you get benefit. What to do with the benefit? You know, benefit increases return. Benefit increases return, therefore we add it. So benefit can be added as well as deducted. Similarly, about loss. Let's suppose you got a borrowing case. You will firstly write actual cost of borrowing, and then you found you incurred loss due to FRA. So if you got actual cost of borrowing, then you got loss. What to do with the loss? Add or less? It can be both. If you have actual cost of borrowing above and you got loss, loss increases cost, therefore we add it. Loss increases cost, therefore we add it. But let's suppose you get a deposit case. So you'll first write actual return on deposit. You will write actual return on deposit. Okay. And then you got loss due to FRA. So loss is likely to reduce my return, therefore I deduct it. Okay. Now also remember, a rule of FRA. Also remember a rule of FRA which works in real markets as well. If FRA is 5-7, if FRA is 5-7, it means it will start in 5 months and last for 2 months. If it states FRA is 5-7, means will start in 5 months and last for 2 months. The first digit is when it will start, and the gap is the lasting period. Okay. Similarly, if someone states FRA 6-8, means it will start in 6 months and last for 2 months. Abdul Wahab, as far as your question is concerned, around 200 plus people have joined the group, and I sent my number in both classes, and whoever messaged me, I have added him in the group. But I think if you are messaging during the class, or right before the class, I can't add in the group. So I will add you after the class, don't worry, okay? Similarly, if someone says that FRA is 7-10, so 7-10 means will start in 7 months and last for 3 months, okay? If someone states FRA is 5-8, means start in 5 months and last for 3 months, okay? If someone says FRA is 10-12, will start in 10 months and last for, okay? This is how FRA rules work, and I've told you the FRA format. This is how FRA rules work, and I've shown you FRA format as well, okay? Let's move to the second technique, which is called interest rate futures, okay? Now, interest rate futures has historically proved to be one of such techniques which always create problems for students. Means I am quite sure even when I teach online courses, there are many students from here and there always asking, we need some video lectures on interest rate futures and specific swaps and specifically. So this is an area which has been challenging for students, but I show you, if you follow this strategy, which I'm telling you, okay, and present this in the exam, you can get full marks. Like my students usually are not worried with interest rate futures. Since I'm not in a position to explain more than one question today, so again, you can refer to the September webinar, day 3, and there you can also refer one more question of interest rate futures so that you get a sound understanding. Okay. Now, how to handle interest rate futures? First, remember, either you will get a borrowing case or a deposit case. Like remember yesterday we said that in payment we have to buy call option, in receipt we have to sell put option. There were rules of options. Similarly, there are rules of futures. If it's a borrowing case, we use the sell now buy later strategy. And if it's a deposit case, we use buy now sell later strategy. Okay, if it's a borrowing case, we use sell now buy later strategy. If it's a deposit case, use buy now sell later strategy. Okay. Now, what to do in interest rate futures? Now, in interest rate futures, there is a 7-step approach. In interest rate futures, there is a 7-step approach. It is highly unlikely you will get all 7 steps by just reading it once. But again, if you don't understand any step, just wait till I do the question and that will be 100%. Okay. So the first step of futures is that you need to find number of contracts as follows. Borrowed or deposit amount over contract size. You know what is the borrowed or deposit amount divided by, you know what is the contract size into time period of borrowing or deposit, for how long you are borrowing or depositing over 3. This is the first step. You need to find number of contracts. It's borrowed or deposit amount over contract size into time period for how long you're borrowing or depositing over 3. This is the first step. Okay. Now the second step is to find basis risk. Second step is to find basis risk. Basis risk is computed as follows. Spot price minus LIBOR less the futures price which will be given. Spot price. The spot price of interest-bearing bonds is always 100. The spot price of interest-bearing bonds is always 100. So spot plus LIBOR less futures price that will be given. Okay. Basis is basically the commission. If today's rate is 10%, no one is going to book you in future for 10%. They will charge a different rate, their commission. That's basis. This happens in currency as well, although we didn't use the basis approach in currency. But let's suppose today's Pakistani and USD, the dollar rate is, let's suppose, 160. If you plan to pay someone in 4 months and there's a risk that dollar rate may go up, no one is going to offer you a fixed rate after 4 months for 160. They will charge something extra. That's the basis. Okay. Third step is a bit tricky. Find unused basis. Unused basis is basis risk into extra months over total months. Now, what is this unused basis? Remember, the futures contracts are only available for 4 months. 30th March, 30th June, 30th September, 30th December, every quarter. The futures contract is only available for 4 months. 30th March, 30th June, 30th September, 30th December. There's no other option of getting futures contract. It's 30th March, 30th June, 30th September, 30th December, internationally, anywhere in the world. Now let's suppose you have to borrow or deposit on 30th March. Let's suppose you need to borrow or deposit on 30th March. So you take a 30th March future rate locking contract. If you need to borrow or deposit on 30th June, you need to take a 30th June contract. If you need to borrow or deposit on 30th September, you will take a 30th September contract. And if you need to borrow or deposit on 30th December, take a 30th December contract. Whatever contract you were willing, you got it. Let's suppose you needed to borrow or deposit on 30th August. You needed to borrow or deposit on 30th August. There's absolutely no future available for 30th August. It's only for 30th March, 30th June, 30th September, 30th December. So if you need to borrow or deposit on 30th August, there is no future available for 30th August. You will need to get a future for 30th September. Did you take any extra months? Yes, you took 1 extra month. That's the unused basis, the extra basis. Okay. Similarly, let's suppose you need to borrow or deposit on 30th Jan. So you will be needing a 30th Jan contract, but there is no contract for 30th Jan. It's either 30th March, 30th June, 30th September, 30th December. So if you need to borrow on 30th Jan, you have to take the contract of 30th March. Is it 2 extra months? That's the unused basis. Okay. Then you need to find in step 4 the future closeout price in both cases. There will be 2 cases in the exam. Interest rates are increasing, interest rates are decreasing. So you need to find future closeout price in both cases. Spot minus LIBOR plus unused basis. It's spot minus LIBOR plus unused basis. And then in step 5, you find the tick size if not given. It's contract size into 1 over 10,000 into 3 over 2. What is this tick? Tick is by how much currencies fluctuate. It's usually established in international markets. Okay, like in Pakistan Stock Exchange, PSX, the tick size is 0.1. That means a share can move in pieces of 0.1. So a share is of 10. It can be 10.1, 10.2, 10.3. It can never be 10.02. Why? Because the minimum fluctuation tick allowed is 0.1. So from 10, it can become 9.9, 9.8, 10.1, 10.2, but never be 9.85 because the minimum fluctuation tick is 0.1. Let's suppose in gold markets, tick is $1. That means the minimum fluctuation in gold price can be $1. So if gold is at $1,800, It can be 1801, 1805, 1806. It can never be 1802.3. Cannot move by 0.3 because the tick fluctuation is okay. I'm repeating these 5 steps, and then if you have any questions, you can ask, and then we will move towards the further steps. So the future strategy of borrowing is sell now, buy later, and of deposit is buy now, sell later. The first step is to find number of contracts as follows. It's the borrowed or deposit amount over contract size into time period of borrowing or deposit over 3. Then you need to find the basis, commission, spot less LIBOR, less futures price that will be given. Unused basis, I explained you, if you have to borrow a deposit on 30th March, 30th June, 30th September, 30th December, you will get the contract for those dates. If you need to deposit at 1st June, you won't get a contract for 1st June. You have to take for 30th June, 30 extra days, 1 month extra. That's the unused basis. Then find future closer price in both places, and then find tick. Any questions? Abdul Wahab, you need to wait for that. There will be 2 cases in the exam. Either it's increasing or decreasing. Alvin, yes, unused basis and remaining basis are the same. Yes, Shalima, spot price will always be the same. Sandeep, I have already told you that I will share this file. 10-12 means start in 10 months, last for 2 months. Anjali, it is confusing if you are studying it for the first time, but if you do 2-3 questions, then it's perfectly fine. Ali Akbar, if you have to borrow on 30th Jan, you need a 30th Jan contract, but 30th Jan contract is not available. It's 30th March, 30th June, 30th September, 30th December. So you will be taking the very next one, 30th March. That means 2 extra months. As per tick formula is also given in step 5. Sandeep, I will do a proper question with you, not just examples. So kindly wait for that, please. So I've already shared that format file on the WhatsApp group. Okay, so interest rate futures is a bit confusing, no doubt, but I will strongly recommend you to wait till the question is being solved. And after that, I will also, I've already suggested you that in September 2020 day 3, this one question was also covered on interest rate through these formats. So you will find a complete firm grip once you do those 2 questions. Okay. So in interest rate futures, the strategy of borrowing is sell now, buy later, of deposit is buy now, sell later. Number of contracts is easy. Basis risk is easy, spot less LIBOR, less futures price, that's given. Then unused basis, that you only get contract for 30th March, 30th June, 30th September, 30th December. Anything extra, that means you have to take for extra months in mid months. Then future closer price in both cases, increase or decrease, then tick if it's not given in the question. Then in step 6, you need to find the outcome of hedge in case of LIBOR increase and decrease. You are likely to get two cases, one of increased interest rates, one of decreased interest rate. So you need to find the outcome of hedge in both cases, increase, decrease. It's again actual cost of borrowing or actual return on deposit, like the same you did in FRA, actual cost of borrowing or actual return on deposit. Okay. Amount into interest rate into time period over 12. It's exactly the same like FRA. Actual cost of borrowing if it's a borrowing case, or actual return on deposit if it's a deposit case. Amount into rate of interest into time period over 12. Then in FRA you wrote add or less gain or loss due to FRA. Here you need to show gain or loss due to futures. Okay, it's the same. Difference in futures price and future closer price into spot into number of contracts into tick. I've told you benefit can be added, benefit can be deducted. It depends. Benefit increases return, therefore added, but benefit reduces cost, therefore deducted. You get net benefit or cost. And finally, you need to find effective interest rate in the last step. Net cost or net return divided by borrowed or deposit amount into 12 months over time period of borrowing or deposit. Okay, so this file has been shared to the WhatsApp group as well, and this file has been uploaded in the handout section of today's class as well. Okay, so you can take this file from wherever source you want. Okay. Basis is the commission Ambika. Okay, now one last technique is the options. In options, again, the first rule, in case of borrowing, you need to take put option. In case of deposit, you need to take call option. In borrowing, take put option. In deposit, take call option. Now, what is the format of options? Now, I am just guaranteeing you that options is just a 2-minute task if you have done futures. If you have done futures, that's tricky and detailed, no doubt about it, but options is just a 2-minute task if futures is done. Now, the format of options is, again, there are two cases. Increase in LIBOR and decrease in LIBOR. You're likely to get two cases, increase as well as decrease. Firstly, you need to write in step 1 the exercise price of options, whatever is the exercise price of the options that's given in the exam. Then you need to compare it with future closeout price from futures. You already computed future closeout price from futures, just note that. Compare this exercise price of option with future closeout price to decide whether to exercise yes or no. If it's a gain, exercise. If it's a loss, no. I will tell you how to get this gain or loss, but compare exercise price with future closer price. If it's a gain, exercise yes. If it's a loss, no. I will tell you how to decide yes or no. Then write gain in basis points if yes. Then find total gain as follows: gain in basis points into number of contracts into tick. Then note actual cost of borrowing or actual return on deposit. Copy this from futures. Actual cost of borrowing or actual return on deposit from futures. And finally, you need to show the premium payable as follows: premium into spot into number of contracts into tick. Because whenever you enter into options, you need to pay. You get net return on net cost. Once you get net return on net cost, you need to compute the okay. If there is one exercise price given, you have to show on one. If there are two given, on two. This is how options work. Okay. So things might sound a bit scary as well as tricky because there are heavy formulas involved, and people usually don't like to learn formulas. But if you do 5, 6 questions of a particular topic. Through this, the formulas would be feeded in your mind. That's your choice how many question practices you do. I can do one question as well as one from the September 2020 webinar, so that you get 2 questions. Further questions, you can do it on your own. Now, we have discussed up till now in today's class that firstly, what exactly is interest rate risk? So we told you that interest rate risk is the risk that interest rates will go up if we need to borrow, or interest rates will go down if we need to deposit. Okay. Common techniques to hedge interest rate risk, because it cannot be eliminated, it can only be minimized. The common techniques are FRAs, futures, options. FRA 4-6 means start in 4 months, last for 2 months. First number is the starting period and the gap is the lasting period. Okay. Second technique, that is format of FRAs, it's actual cost of borrowing or return on deposit, and then gain loss due to FRA can be added, can be deducted. Okay. Then futures, 7 heavy steps: number of contracts, then basis, then unused basis, then future closeout price in both cases, then tick, then actual cost of borrowing or return deposit, and then premium payable. And finally, last thing is the options. It has 8 steps, but options will be a 2-minute task if futures is done. Okay. So I think without wasting further time, we should move towards the question. Now I am opening the question handout of today. You also have it. I would advise you all to open as well. And I want all of you to firstly read this question on your own. I want all of you to firstly read this question on your own, and then I will read it for you, and then we will solve towards the solution. Okay, so I'm giving you 4 or 5 minutes. Take your time and read this question. Okay. You can continue reading the question from your own, because I have moved towards a different screen. I'm opening the software. Okay, now I am reading the question, and after that we will move towards the solution. Let's start the question. The question is, Wadikul Company, a company based in Eurozone, has expanded very rapidly over recent years by a combination of acquiring subsidiaries in foreign countries and setting up its own operations abroad. Wadikul's board has found it increasingly difficult to monitor its activities, and Wadikul support functions, including treasury, have struggled to cope with generally increased workforce. Vertical's board has decided to restructure the company on regional basis with regional boards and appropriate support functions. Managers in some of the larger countries in which Vertical operates are unhappy with reorganization on a regional basis and believe operations in their countries should be given a large amount of autonomy and be supported by internal forces. Assume it is now 1st October 2017. The central treasury function has just received information about a future transaction by a newly acquired subsidiary in Urea, where the local currency is dinar. The subsidiary expects to receive dinar 27 million on 31st January 2018. It wants this money to be invested locally in Urea, most probably for 5 months until 30th June 2018. Wadikul's treasury team is aware that economic conditions in Urea are currently uncertain. The central bank base rate is the LIBOR, interbank rate. The central bank base rate in Urea is currently 4.2. And the treasury team believes it can invest funds in Urea at the central bank base rate less 30 basis points. So the base rate, central bank rate, interbank rate is 4.2. And treasury team believes it can invest funds at base rate less 30 basis points. 30 basis points means 0.3%. 1% is 100 basis points. 1% is 100 basis points. 30 basis points is 0.3%. However, the Treasury staff have seen predictions that the central bank base rate could increase by up to 1.1 or fall by up to 0.6% between now and 31st January. I told you there are always going to be two cases in the exam. So here the Treasury staff have seen predictions that the central bank base rate could increase by 1.1 or decrease by 0.6. Wadikul's Treasury staff normally hedge interest rate exposure by using whichever of the following products is most appropriate: FRAs, interest rate futures, and options. So Wadikul's treasury staff normally hedge interest rates by using whichever of the following products is appropriate: FRAs, futures, and options. Treasury function guidelines emphasize the importance of mitigating the impact of adverse movements in interest rates. However, they also allow staff to take into consideration upside risk associated with interest rate exposure. A local bank in Urea with which Wadikul has not dealt before has offered the following FRA rates. So local bank is offering what FRA rates? 4-9, 5.02, and 5-10, 5.1%. So local bank is offering the following FRA rates: 4-9, 5.02. The treasury team has also obtained the following information about exchange traded dinar futures and options. So 3-month futures, it's with 3-month gap, right? December, March, June, September, I told you. So 3-month futures, 500,000 is the contract size. Prices are quoted in basis points at 100 minus annual yield percent. Spot is 100 minus percent. December futures, March futures, June futures are given. There can only be one more future, that's September. That's not given, no concern. December, March, June futures are given. Then you are given with options data. 5 lakh is the contract size, 500,000 option premiums are in percentage. There are 2 exercise prices or 2 strike prices given in the middle. Strike price or exercise price is the same. So there are 2 strike prices or 2 exercise prices given in the middle, 94.25, 95. And you are given calls as well as put options for December, March, June, and the figures in between for calls and puts for December, March, June are the premiums at both prices. At 94.25, the whole row is the premiums, and at 95.25, the whole row is the premiums. It can be assumed that futures and options contract are settled at the end of the month. I know that I told you yesterday as well that it's always 30th March, 30th June, settlement at the end of the month. Basis can be assumed to diminish to 0 at contract maturity based on monthly intervals. It can't be assumed that there is no basis risk, no margin requirements. And the requirement 1. Recommend a hedging strategy for dinar 27 million investment based on hedging choices which staff are considering. Staff are considering 3 hedging choices: FRAs, futures, options. So recommend a hedging strategy for 27 million investment based on hedging choices if interest rates increase by 1.1 or decrease by 0.6. So you have to work on both ways, if interest rates increase or decrease. That's why in the formats I was always telling you that there are 2 cases: increase, decrease. So if it increases by 1.1 or decreases, you have to recommend a hedging strategy. Support your answer with appropriate calculation and discussions. Okay. Okay, so we have to deal with the absolute patience, all these three techniques, because I want you to get a complete command on this. Okay. Going back to the question. The first paragraph vertical was based in Eurozone. Second paragraph, assume it is now 1st October. Central bank has received information about future transaction by newly acquired subsidiary where local currency is dinar. Subsidiary expects to receive dinar 27 million on 31st January 2018. It wants this money to be invested. Invested means deposited or borrowed. It wants this money to be invested, deposited, most probably for 5 months until 30th June. Third paragraph, Vardigal's treasury team is aware that economic conditions are uncertain. Central bank base rate is 4.2. Treasury team believes it can invest funds in Urea at bank base rate less 0.3%, 30 basis points. However, treasury staff have seen predictions that base rate could increase by 1.1 or decrease by 0.6. So since today is 1st October, the subsidiary is receiving payment on 31st Jan in future and wants this to be invested. There is always be a risk that rates may go down. So treasury staff wants to hedge it through FRAs, futures and options. Okay. Local bank in Urea has offered following FRA rates 4-9, 5-10. Treasury team has obtained information about futures December, March, June, and of options. 2 exercise prices are given. Calls December, March, June, and puts December, March, June. And the requirement is recommend a hedging strategy for dinar 27 million investment based on hedging choices the staff are considering. Futures, options, and FRAs. If interest rate increase by 1.1 or decrease by 0.6. Okay. Okay. Now, if you want to get absolute perfection in this, if you want to get absolute perfection, Anna, please wait, please wait. If you want to get absolute perfection, so follow the strategy patiently. Okay. Before starting any interest rate risk management question, note 4 things with you. If you want to get absolute perfection so that it does not bother you in between, note 4 things. Case. First, note the case. It is of borrowing or deposit. Okay. Second, note today's date. What is the today's date? Third, what is the borrowing or deposit date? And till when borrowing or depositing. This will help you, and you won't be needing to refer to the question again and again if you note these 4 things with you. For starting any interest rate risk management question, just note these 4 things with you. First, note what is the case. Either the case will be of borrowing, either the case will be of deposit. Note the today's date. It could be given most likely. Borrowing or deposit date given. Till what date you are borrowing or depositing, it will be given. You just need to note at one place. Okay. So First, we need to note what is the case, borrowing or depositing. So let's search for that. What is the case? Are we borrowing or depositing? Look at the second paragraph. Assume it is now 1st October 2017 and Central Treasury Function has just received information about a future transaction by a newly acquired subsidiary in Urea, where the local currency is dinar. The subsidiary expects to receive dinar 27 million on 31st January 2018. The subsidiary expects to receive dinar 27 million on 31st January 2018. It wants this money to be invested. Deposited, most probably for 5 months until 30th. So the case is of deposit. It wants this money to be invested, deposited. Okay. Then, no 3 dates. Today's date, 1st October 2017. Borrowing or deposited. Go to the paragraph again. Assume it is now 1st October 2017. Central Treasury Function has just received information about a future transaction by a newly acquired subsidiary in Urea, where the local currency is dinar. Subsidiary expects to receive dinar 27 million on 31st January 2018. So dinar 27 million will be received on 31st January 2018. It wants this money to be invested. So at what date you are receiving money, at what date you are investing? It's 31st January 2018. It wants this money to be invested most probably for 5 months until 30th June 2018. Till what time you are borrowing or depositing? The last thing. 30th June 2018. Okay. First note these 4 things. This will really help you. You will see the later part of the question that how this is helping you. You don't need to refer to the question again. All these 4 things will be given in the question. That's a guarantee. You just need to search. All these 4 things will be given in the question. That's a guarantee. You just need to search. Okay. Firstly, the case. The case is of borrowing or depositing. Obviously, the question will state we plan to borrow. Or the question states we plan to deposit. So here it is saying that we are receiving 27 million dinar and we plan to invest, deposit. Today's date was given. At what date we were receiving and depositing? 31st January 2018. Until what time period or date we were borrowing or depositing? 30th June 2018. Note these 4 dates firstly. That's your first step of the question. Any questions with these 4 dates? No other questions, only with this 4 dates, because we will start discussing techniques and there you can ask your questions. Amika, this doesn't sound a good question. Do we hedge twice, once from now till receipt? Why hedging from now till receipt? When we will receive, then the hedging will start. We don't have the money now. How can we hedge at the moment? Okay. So before starting any interest rate risk management question, I have told you that you need to write these 4 things first. Case, it's deposit. Today's date, 1st October 2017, borrowing deposit date, 31st January 18, until what date? 30th June 2018. Now, the company was expecting to receive 27 million dinars, which it plans to deposit, but there was a risk that rates may go up or down. So company plans to hedge it. There are 3 techniques under consideration: FRAs, futures, and options. Okay. If you need to recommend a hedging strategy, there are 3 hedging strategies which company is considering. So in order to recommend, you need to solve all of them and then recommend. Like yesterday, it was asking to recommend a hedging strategy. So Yesterday also in currency risk management question, it asked for recommendation of hedging strategy. So how do you recommend? There are three techniques to solve all and then recommend. So here also you are asked to recommend hedging strategy for this investment. The company is considering three hedging strategies: FRAs, futures, and options. You need to solve all and then decide. So I am solving the first technique, which is called forward rate agreements. Okay, let's solve forward rate agreements and then we'll be in a position to decide. Okay. So let's start forward rate agreements, and you have to work on two cases. The first case, if interest rates increase by 1.1%, okay, and second case, if interest rates decrease by 0.6%. Every technique has to be solved in both cases, increase case as well as decrease case, because I want you to refer to the requirement once more. You see, recommend a hedging strategy for the 27 million investment based on the hedging choices which treasury staff are considering. So you need to recommend hedging strategy based on hedging choices, or three hedging choices which you are considering. If interest rates increase by 1.1 or decrease by 0.6, so you need to recommend hedging strategy for this investment if interest rates increase or decrease. So you're solving the first technique, forward rate agreement, and you need to solve it in both cases if it increases or decreases. Okay, let's first note the format of forward rate agreements. You firstly need to write actual return on deposit or actual cost of borrowing, and then you need to write benefit or loss due to FRA, so that you get the net answer. So if you look at the format here, you need to firstly write actual return on deposit or actual cost on borrowing. So tell me, is it a deposit case or a borrowing case? It's a deposit case. So we will write actual return on deposit or actual cost of borrowing. We will write actual return on deposit. Okay. Okay. And then you need to add or less gain or loss due to FRA. You get the net cost or net return. You will get the net return because it's a deposit case. You get the net return. right? This is the format of FRA, which is in front of you, that you need to firstly write both cases working, increase or decrease. So actual cost of borrowing or actual return on deposit. It's a deposit case, so you need to write actual return on deposit, and then gain loss due to FRA, either the gain or loss. You will get net return on net cost. Okay, you need to work if interest rates increase or decrease. Okay. Now there are two FRA rates given in the question. There are two FRA rates given in the question. See, one FRA rate is given. A local bank in area with which Varticol has not done before has offered the following FRA rates: 4-9 and 5-10. Okay, which one will you opt? Now see my fingers. See my fingers. Today's date is 1st October. Today's date is 1st October. We have already written this. Now here it will help you. Today's date is 1st October. When do you plan to borrow a deposit? You need to plan to borrow a deposit on 31st Jan. Now look at my fingers. Today is 1st October. You need to borrow a deposit on 31st Jan. Now start counting. Today is 1st October. 1st October to 1st November, 1 month. 1st November to 1st December, 2 months. 1st December to 1st January, 3 months. And 1st January to 31st January, on which you will borrow a deposit 4 months. You need to borrow a deposit after 4 months. You need to borrow a deposit after 4 months. Today's date is 1st October. You need to borrow a deposit on 31st January. So you will borrow a deposit after 4 months. How? 1st October to 1st November, 1 month. 1st November to 1st December, 2 months. 1st January, 3 months. 31st January, 4 months. You will borrow a deposit after 4 months. You will deposit after 4 months because today is 1st October. You will deposit on 31st Jan after 4 months. For how many months? You will deposit on 31st Jan till 30th June. You will deposit on 1st Jan till 30th June. So count 31st Jan to 31st Feb or 28th Feb, end of Feb, 1 month. Then 30th March, 2 months. Then 30th April, 3 months. Then 30th May, 4 months. And then 30th June, 5 months. You will deposit after 4 months for a period of 5 months. There are two FRAs given. If had it been a single FRA, I would have used that. But there are two FRAs. Which one to opt? Let's see the days. Today is 1st October. You need to borrow a deposit on 31st Jan. If you count it, it's after 4 months. For how many long? For till 30th June, for 5 months. Now, if you need to deposit after 4 months for a period of 5 months, the relevant FRA is 4-9. If you will deposit after 4 months for a period of 5 months, the relevant FRA is 4-9, because 4-9 means you will deposit after 4 months. Agreement will start after 4 months and last for 5 months. Okay, so this is how things move. I have not yet made any calculations, but still, in order to be able to understand things, we have made the complete format of FRA. I told you that when you plan to start any question on interest rate risk management, just note the 4 things first. Case, you have all clear information now that the case is of deposit. Note today's date given, just find it. Borrowing deposit date, it's given, just find it. Until what date you are borrowing or depositing, that's also given. Okay. Now you need to decide which is the best one through all 3 techniques. The first technique is FRA. Okay. You have to solve the FRA and a technique in 2 cases: if interest rates increase or decrease. Wrote both. I noted the format: it's actual cost of borrowing or return on deposit. So return deposit, gain loss due to FRA, find the net return. Okay. Now which is the relevant FRA? I will be depositing money after 4 months. For 5 months, relevant FRA will be 4-9, and 4-9 is, I think, 5.02%. Which is 5.02%. Okay. Now let's start the working for FRA. If interest rates increase by 1.1%. Now, if interest rates increase by 1.1%, let's just make a calculation. Actual return on deposit. Now, how do we get actual return on deposit? Go to the formula sheet. Actual return on deposit is the amount into rate of interest into time period over 12. Amount into rate of interest into time period over 12. Amount into rate of interest into time period over 12. This is the actual return on deposit. Amount into rate of interest into time period over 12. So, how much amount you are depositing? Dinar 27 million. This is the amount. Dinar 27 million. Into rate of interest. What will be the rate of interest? The rates have increased by 1.1. The rates have increased by 1.1. Now the LIBOR rate or the central bank rate was 4.2%. The LIBOR rate or the central bank rate was 4.2%. So the LIBOR rate was 4.2%, but you are dealing the case that it's increased by 1.1. LIBOR rate was 4.2, and you are dealing the case that it's increased by 1.1. So in this particular case, the rates have become 5.3. The rates have become 5.3. So if you deposit dinar 27 million, the rates have become 5.3. You won't get 5.3 because the question states that you can invest money at central bank rate less 30 basis points. So 0.3% less. You are getting actual return on deposit amount into rate into time period over 12. So amount is 27 million. Since rates have increased by 1.1 to 4.2 was the central bank rate. If it's increased by 5.3, you will be investing at 30 basis points, 0.3 less. So you will get 5.3% less 30 basis points. You will get 5%. Okay. Multiplied by time period of borrowing over 12. So for how long you are borrowing? If you apply 5% on 27 million dinar, that's per annum. You are not getting return for whole year because you are not investing for whole year. You're only investing for time period of 5 months over 12 months. Okay. This will make it dinar 562 500. This will make it 562 500. Okay. Get a picture of how this actual return on deposit is computed. It's amount dinar 27 million into rate of interest 5% into time period over 12. Okay. Then deal with gain or loss due to FRA. Now, gain or loss due to FRA is very simple in computation, but you just have to make sure that you apply whether it's a gain or loss. Whether you apply it's a gain or loss. Please pay attention because there is another case as well so that you will get a sound. So, how is the gain or loss due to FRA computed? See the formula. It's just the difference in rates into amount into time period. Just the difference in rates into amount into time period. So what is the difference in interest rates? For this case, the rates increased by 1.1 became 5.3. The rates increased by 1.1. For this case, they became 5.3. The rates increased by 1.1 became 5.3. But you lock the rate with the bank at 5.02. The rates increased by 1.1 became 5.3, but you lock the rate at 5.02. So this is the difference in rates. Into amount into time period over 12. This makes it 31,500. This makes it 31,500. The formula of gain or loss due to FRA is the difference in rates. The rates became 1.1 increasing 5.3, but we locked at 5.02 into amount into time period over 12. Now, important thing, this is a gain or loss, will be added or deducted. It matters most. It's a gain or a loss, will be added or deducted. Now, it's a deposit case, right? The rates became 5.3. Try to understand this. The rates became 5.3. The rates became 5.3, but you locked the deposit rate at 5.02. The rates became 5.3, but you locked the rate at 5.02. Did you got loss or gain? Loss, because the rates became 5.3, but I locked at 5.02. It's a depositing case. I got loss. Loss will be added or deducted. It depends. In the above statements, it's a return and you get loss. So loss is likely to reduce your return, therefore you deduct it. Loss is likely to reduce your return, therefore you deduct it. The net answer which you will get is 531,000. This ends if interest rates increase by 1.1. How do you get the actual return on deposit? It's the amount into rate. How do we get the rate? Interest rates increased by 1.1 became 5.3. We can't deposit at 5.3. We can deposit at 530 basis points, 0.3% less to time period over 12. Then gain loss due to FRA. It's just the difference in rates. The rates became 5.3, but we committed at 5.02. Deposit, we committed less. It's a loss. Into amount into time period over 12. Loss reduces return, therefore deduct. Okay, now to get a grip, just look at another case. Just to get a grip, just look at another case. Then we will take questions. You have to solve on another thing. If interest rates decrease by 0.6, another cases, because you need to recommend hedging strategy if interest rates increase or decrease. Let's suppose interest rates decrease by 0.6. How do we get the actual return on deposit? It's the same formula. Amount. What is the amount? Into rate of interest. The central bank rates are 0.6. Sorry, central bank rates are 4.2. If interest rates decrease by 0.6, they become 3.6. The central bank rates are 4.2. If rates decrease by 0.6, they can become 3.6. But you won't get the return on 3.6 because you can invest this funds at 30 basis point, 3.3% less. So the rates fell by 0.6, became 3.6. You can invest at 0.3 further less. You will invest at 3.3%. Into time period. For how long you are investing? 5 months over 12 months. This makes it 371,250 dinars. If interest rates decrease by 0.6, 4.2 is the bank rate, it decreases by 0.6, becomes 3.6, but you can invest at 0.3 less, 3.3 into time period over 12. Then gain loss due to FRA. Please pay attention how to get gain loss due to FRA. It's the difference in rates. It's the difference in rates. The rates fell by 0.6, became 3.6. The rates fell by 0.6, became 3.6. But you committed an FRA at 5.02. This is the difference in rates. That the rates decreased by 0.6, became 3.6, but you committed at 5.02. Into amount, you know, 27 million. Into time period over. This makes it 159.0. Last thing, it's a gain or loss. It will be added or deducted. So note. The rates decreased by 0.6, became 3.6, but you locked the rate through FRA at 5.02. It's a deposit case. The rates fell to 3.6, but you locked at 5.02. Did you got gain or loss? You got gain because the rates became 3.6, but you locked at 5.02. So you got a gain. Will be added or deducted. Note the above rule. You have got return and above rule. Gain will increase return, therefore add it. Gain will increase return, therefore add it. So the net return will be adding both. $530, 1,000. Now, this is the proof that all your workings are right, that both cases will produce the same net answer. This is a proof that your answer is right, that both cases will produce the same answer. Now, FRA is ended, but as the last thing in FRA, you should find the effective rate. As the last thing in FRA, you should find the effective rate. Now, effective rate is computed as, I have given you the formula already. Effective rate is computed as net return. So net return is 530, 1,000 over borrowed deposit amount, that was 27 million. Net return, that is 531,000 for both cases, over borrowed or deposit amount, that's 27 million, into 12 months over time period of borrowing, that was 5 months. So effective rate is going to be 4.72%. Okay, this is the effective rate. You need to write this effective rate, and the proof is that both options will give the same answer, increase, decrease. That's the proof that your working is right. 531 net return over borrowed or deposit amount into 12 over 5 months. Okay, my FRA technique is over. If you have any questions, you can ask, and then you can copy, and we will move towards the next question, next technique. Nirupoma, first your question. So we are only investing at 30 basis points less. So we are only investing in the first row when we are finding return. When you're finding gain or loss, you are not investing. So you will take 5.3. Only when you're calculating your return, you will take 30 basis points less. Kritika, same solution for you as well. For Keshav, you as well. For Jason, you as well. Okay, that whenever you are calculating your return on deposit, okay, so while depositing, you will get 30 basis points, 0.3 less. So instead of 5.3 and 3.6, I took 5.0 and 3.3. But when calculating gain or loss, it should be like with like. 5.02 is the locked rate. It should compare with the rate which you are getting in the market. That's 5.3. Otherwise, the impact would be 2 times. FNWA 3.3 is that if interest rates decrease by 0.6, central bank rate is 4.2, decrease by 0.6 means becomes 3.6, and you are investing at 30 basis points, 0.3 further less, so 3.3. IUNI, we have to take one FRA, either 4-9 or 5-10. So since today's date is 1st October and the borrowing deposit date is 31st January, we are depositing after 4 months for 5 months. So the principle states that if you are starting after 4 months, for 5 months, it should be 4-9. That's why we took for 5.02. Kritika, that's the reality. Whatever is the central bank rate, you always get less than that. Yes, Anjali. Alvin, it's your choice. You can show bracket. Makaiko, please wait. Effective rate, what it tells us, we will discuss it later. Mohammed Taghi, because we are not getting 3.6, we are getting 30 basis points less. Amdi Rizwan, today's date is 1st October. We are depositing on 31st January. So if you count 1st October to 1st November, 1 month, 1st December, 2 months, 1st January, 3 months, and 31st Jan, 4 months. We are starting after 4 months for 5 months, then it's 4-9. Jack Ryan, it's very simple. Borrowing rate is always higher, deposit rate is always lower. Okay, Tajwar. So the loss or gain is calculated like this: difference in rates. So if interest rates increase by 1.1, the rates of market become 5.3. If they decrease by 0.6, it becomes 3.6. 4.2, 0.6 decrease, 3.6. And you compare it to your lock-in rate. So 5.3 and 5.02. So the rates increased to 5.3, but you locked at 5.02. The rates became 5.3. You could have got 5.3, but you committed at 5.02. That's why it's loss. Loss reduces, return deducted. But in second case, rates decreased by 0.6. So it became 3.6. Okay. So when it became 3.6 and the market rate is 5.02, rates became 3.6, you locked at 5.02. It's a gain, and gain increases, return therefore added. If it's 1st January, you are depositing on 31st January. So it's exactly 1 month, 30 days. Since it's 1st October, you are investing on 31st January, so it makes 4 months. Ionic where rates became increased by 1.1. So rates increased by 1.1. So what is today's rate? Is the central bank rate 4.2. If it increases by 1.1 becomes 5.3. If it decreases by 0.6 becomes 3.6. Ademo, your question that the market rate becomes 5.3. So you could have got 5.3 and deposited, but you locked at 5.0 to reduce rate. It's a loss. Makaiko, we can only invest funds at 30 basis points less. So you are not investing in the second row, you are only investing in the first row. So in the first row, when you are investing, you consider that, but in the second row, you are not investing, it will create a double impact. I think we should head for a break now. And after the break, we will continue on the futures and then options. Okay. Tajwar, I'm not seeing a basis anywhere in this technique. The basis comes in futures. Okay, so we are now resuming the class. Okay, let's now start futures for this question. Okay, so as far as interest rate futures is concerned, in interest rate futures, you have to work around and show 7 steps. Okay, the first step is to find number of contracts. Look at each and every step in detail so that you get a firm grip. The first step is to find number of contracts. I will explain each and every step so that you get a complete idea. Okay, first step is to find number of contracts. Now, number of contracts is basically found by taking, see the format, borrowed or deposit amount over contract size into time period for borrowing or deposit over 3. So it's basically borrowed or deposit amount. Borrowed or deposit amount is dinar, 27 million, into contract size. Go to the question. What is the contract size of futures? 500,000. Borrowed or deposit amount divided by contract size. So divided by contract size, 500,000 into time period of borrowing over 3. What is the time period of borrowing? You're borrowing or depositing for 5 months? Over 3. Why 3? Because these contracts expire every 3 months, March, June, December, September. So we get the number of contracts as 90 contracts. This is the first step to find number of contracts. Okay. Now the second step is to find basis risk. The second step is to find so the formula for basis risk is here. Spot less LIBOR less futures price it will be given. So you need to take spot less LIBOR, spot is 100, less LIBOR. LIBOR is the central bank rate or interbank rate, remember, 4.2. Spot less LIBOR, less futures price. Futures price will be given in futures. Go to the futures. What is the futures price? In futures, there are few futures prices. December 17 futures price, March futures price, June futures price. So it's spot minus LIBOR less the futures price. So which futures price will we take? Now listen this thing carefully. Which futures price will we take? Remember, you were borrowing or depositing on 31st Jan. You were borrowing or depositing on 31st Jan. It's spot minus LIBOR less futures price. You were borrowing on 31st January. You would ideally want a future for 31st January. You want to borrow or deposit on 31st Jan. So you ideally want a future for 31st Jan. There won't be future for January. It's only March 30th, June 30th, September 30th, December 30th. So you plan to borrow or deposit on 31st Jan, but there's no future for 31st Jan. It's for March, June, September, December. So if you plan to borrow on 31st January or deposit on 31st January, there is only for March, June, September, December, which is the nearest future you can take, the very next one, March. So you will take the March futures of 94.78. So spot price less LIBOR, 100 less 4.2, less futures price 94.78. This gives you basis as 1.02. I've completed 2 steps of 7, sorry. Any confusions in these 2 steps you can ask. The first is number of contracts. It's borrow deposit amount over contract size into 5 months over 3 months, 90 contracts. Best is the spot, always 100. Less LIBOR, the interbank rate, 4.2. Less futures price, that will be given in futures. There are 3 futures given. Maximum it can be for 30th March, 30th June, 30th September, 30th December. You plan to borrow or deposit on 31st Jan. So the very next future you will take is of 30th March, 94.78. Okay. Any questions in these 2? Nirupama, you were borrowing or depositing on 31st January. So you ideally needed a contract at 31st January. You were planning to borrow or deposit on 31st January. So you ideally needed a future of 31st January. If the future is of 31st January, which is the very next future that is available, March or June? So we'll take March. Why can't we take June? And if in we are not taking December because December would have passed till 31st January. The very next one is March. Amna, it's no basis risk for now, but when in futures, it will be a basis risk. Keshav, the 30 basis points only come when we are investing money and calculating our return. Unless we are calculating the return or investing money, while calculating the return, we won't take those 30 basis points. Only while computing the return, we will take that 30 basis points. Okay, so let me do 2 further steps, and then I will give you 4 or 5 minutes to copy these 4 steps, then we will complete the remaining 3 steps, okay? Now the third step says you need to find unused basis. What is the formula of unused basis? Go to the handout. The formula of unused basis is basis risk into extra months over total months. Now this is interesting, basis risk into extra months over total months. So what is the basis risk? 1.02 into extra months over total months. Just try to understand how do we get extra months and total months, okay? Extra months. You wanted to borrow or deposit on 31st Jan. So you ideally needed a future of 31st Jan. You wanted to borrow or deposit on 31st Jan. So you ideally needed a future of 31st Jan, right? But you took a future of 30th March. You wanted to borrow or deposit on 31st Jan. So you ideally needed a future of 31st Jan. But you took a future of 30th March. So how many extra months? 2 extra months, 31st Jan to 31st Feb or end of Feb, 1 month, and 30th March, 2 months. So the extra months is 2. Repeat, basis risk into extra months over total months. So extra months, you wanted to borrow a deposit on 31st Jan. So ideally you wanted a future of 31st Jan, but you took for 30th March, 2 extra months over total months. What is today's date? 1st October. What is today's date? 1st October. But you took future for 30th March. Count total months. Today's date is 1st October. You took a future of 30th March. So 1st October to 1st November, 1 month. 1st December, 2 months. 1st January, 3 months. 1st February, 4 months. 1st March, 5 months. And 30th March, 6 months. So total months are 6. This makes it 0.34. I'm repeating again. The unused basis is basis risk 1.02, just compute it, into extra months over total months. Extra months. We wanted to borrow a deposit on 31st Jan, so we needed a future of 31st Jan. But we took a future of 30th March, so 2 extra months. Total months, today's date is 1st October. We took a future of 31st March. So the total months are 1st October to 1st November, 1 month. 1st December, 2 months. 1st January, 3 months. 1st February, 4 months. 1st March, 5 months. And 30th March, 6 months. This is how you get unused basis. Okay. Now you need to find future closeout price in both cases. First case is interest rates increase by 1.1, and the second case is interest rates decrease by 0.6%. So you need to find future closeout price in both cases. That's what step number 4 says. interest rates increase by 1.1 and decrease by 0.6. There are two cases. So how do we get the future closer price? Look at the format. It's spot minus LIBOR less unused basis. Okay. Spot minus LIBOR less unused basis. Spot minus LIBOR less unused basis. So spot minus LIBOR means 100 minus. What is the LIBOR here? What is the LIBOR here? 4.2, but it's increasing by 1.1. LIBOR is 4.2, but it's increasing by 1.1. So it's 5.3. Okay. And spot minus LIBOR. Spot is 100 minus LIBOR is 4.2, but here it's decreasing by 0.6. So it's 3.6. Again, the question comes, sir, why didn't you take that less 30 basis points here? I will only take that when I'm investing. I'm not investing money in step 4. It's just spot minus LIBOR. So spot is 100, LIBOR is minus 4.2, but this is the case of increase by 1.1, so it becomes 5.3. And this is the case. Spot 100 minus LIBOR 4.2, but decrease by 0.6, 3.6. Okay, so this is spot minus LIBOR and less unused basis. What is the unused basis? It's 0.34. It's 0.34 unused basis. You have just calculated that. So spot minus LIBOR less unused basis. You get future closeout price in both cases. You get future closeout price in both cases. 94.36 and 96.06. So if interest rates are increasing and decreasing, you need to find future closeout price in both cases. It's spot minus LIBOR, 100 minus 4.2, but increase by 1.1 means 5.3, decrease by 0.6 means 3.6. Less unused basis calculated above, you got future closeout price in both cases. Okay, you can note these 4 steps and I can take any questions if you have. So extra months is basically you are depositing on 31st Jan, but you took future of 30th March. So 2 extra months. Total months is from today's date till future date. Today's date is 1st October and you took future of 31st March. So you counted it 6 months. Yes, so the contract period is 3 months. No, you have to show how you arrived it. Then step 5 is easy. It states find tick size. The formula of tick size is if not given in the question. So let me see if the tick is given. Tick is not given. So you need to find tick size. The formula for tick size is contract size into 1 over 10,000 into 3 by 2. So contract size is 500,000 into 1 over 10,000 into 3 by 12. It's 12.5. So now we are done with 5 steps. We only have 2 steps left. So I want you to make sure you don't have any problem in these 5 steps. Just go through these 5 steps. We are doing it very, very slowly. Just go through these 5 steps so that if you are clear with that, then I can complete the last 2 steps and that would be it for futures. That's why it's not 3 years, it's 3 months. Yes, Fasi, I will explain it to you, don't worry. Okay, so FRAs had been completed. Okay, but now we were moving towards futures. You have to show 7 steps in futures. The first step is the number of contracts. It's the amount of borrowing deposits, 27 million. Our contract size, 500,000 into time period, that is 5 months over 390 contracts. Basis risk, spot minus LIBOR, 100 minus 4.2, less futures price. Which futures price to select? If you need to borrow a deposit on 31st January, you need a 31st Jan future. Not available, very next one, 30th March, 1.02. Unused basis is basis risk, 1.02, extra months. 31st January is the borrowing and depositing date. You need to contract on 31st January, but you took a contract for 31st March. It's 2 extra months. Total months, today is 1st October. You took a contract of 30th March, it's 6 months. Future closeout price in both cases. The case 1 is increased by 1.1, case 2 is decreased by 0.6. So it's spot minus LIBOR. Spot minus LIBOR, 100 minus 4.2, but in case of increase by 1.1, LIBOR became 5.3, increased by 1.1%, became 5.3. So 100 minus 5.3, 94%. Less unused basis 0.34, you get a future closeout price. And it decreased by 0.6. So 100 spot minus LIBOR 4.2, but decreased by 0.6% means 3.6. 100 minus 3.6 is 96.4. Less unused basis is 0.34, 96.06. And finally, you found T. Okay. Then the next step, the most mark scoring step, which carries the heavy weightage. Find outcome of hedge in both cases. You need to find outcome of hedge in both cases. Okay. The first case is interest rate increased by 1.1%. And second case is interest rate decrease by 0.6%. Okay, you need to find outcome of hedge in both cases. Interest rates increased by 1.1, interest rate decreased by 0.6%. Okay, so what is the format of outcome of hedge in both cases? Firstly, the same thing, actual cost of borrowing or actual return on deposit. So it's a deposit case, you will write actual return on deposit and then add less gain or loss on futures, net benefit, net cost. Okay, it's the same thing. So it's actual cost of borrowing or actual return on deposit. Okay, here it's actual return on deposit. Here it is also actual return Okay, so it's actual return on deposit, and then you need to add or less gain loss due to futures, gain loss due to futures, and you get the net cost or net return, net return, net return. Okay, so this is how things work, that you need to find the outcome of hedge in both cases. So the both cases are increased by 0.6, decreased by 0.6. You need to show actual return on deposit or actual cost of borrowing format. There you wrote in FRA gain loss due to FRA. Here you need to write gain loss due to futures. Okay, so what is the actual return on deposit? What is the actual return on deposit? Check the formula of actual return on deposit. Amount into interest rate into time period over 12. Same thing, same answer. Amount into interest rate into time period over 12. So what is the amount? Dirham 27 million into interest rate. You're finding return on deposit. So amount is dirham 27 million into interest rate. It's 4.2, but you are dealing with the case increased by 1.1, became 5.3. But you can't deposit, get return at 5.3. You're depositing money. You won't get 5.3 even though interest rates have increased by 1.1, become 5.3. You will get 30 basis point, 0.3 less. So 5% into time period of borrowing. It's 5 months over 12. Okay. So the actual return on deposit is going to be the same as computed in forwards. 562 500. Okay. And then gain loss due to futures. Now what is the formula of gain loss due to futures? It's difference in futures contract price and future closeout price. Futures contract price and future closeout price into spot, into contracts, into tick. So you need to take the difference between futures contract price. What was the futures contract price? Remember, you took March futures 94.78. Difference between futures contract price and future closeout price. Remember, in increase case, the future closeout price was 94.36. Futures contract price. The futures contract price is 94.78. Remember, you took March futures in the question, 94.78, and future closeout price. In increase case, you have just calculated the futures closeout price, 94.36 in the fourth step. Into spot, 100, into number of contracts, 90, into tick, 12.5. Difference between futures price 94.78 and future closeout price 94.36 into spot, into contracts, into tick. So the answer will be 47250. But a very important question. It's a gain or a loss. It will be added or deducted. It's a gain or a loss. It will be added or deducted. Now, what is the strategy in deposit? What is the strategy in deposit? See, the strategy in deposit is buy now, sell later. Buy now, sell later. So buy now, sell later. Buy at 94.78 and sell at 94.36. Buy at 94.78, the first price. Buy now, sell later. Buy at 94.78 and sell at 94.36. If you buy something at 94.78 and sell at 94.36, buy at higher 94.78 and sell at 94.36. If you buy something at 94.78 and sell for 94.36 less, it's a gain or a loss? Loss. Loss will be added or deducted. So loss will reduce our return, therefore deduct it. Your net return will be 515,250. I'm repeating. Actual return deposit is easy. 27 million into rate of interest became 5.3, but I deposited 30% less, 30 basis point less into time period over. Gain loss due to futures is the difference in futures price 94.78 and the closeout price already calculated. See here, in case of increase, I'm highlighting it. 94.36. I just made it red. The difference between futures price and futures close price into spot into contracts into tick. So gain or loss. Buy now, sell later is the strategy. Buy at 94.78, sell at 94.36. Loss. Buy higher, sell lower. Loss, and loss reduces return. Just to make sure you understand this properly, let's move to the right side case to verify whether our answer is okay or not. If interest rates decrease by 0.6, it's actual return on deposit, then gain loss due to futures. Actual return on deposit is the amount. Dinar 27 million. Pay attention, please. Into rate of interest. If interest decreased by 0.6, from 4.2 decreased by 0.6 become 3.6, but you won't invest or get deposit return at 3.6. At 0.3% less, 30 basis points less, 3.3%. Into time period 5 months over 12 months. Okay. This makes it 371250. You already got this in futures as well. Sorry, FRAs as well. Now, gain loss due to futures. The formula of gain loss is difference between futures price and futures closer price. Difference between futures price and future closer price. You all know that futures price is 94.78. Futures price is 94.78. Difference between futures price and futures closer price. The future closer price in case of decrease is 96.06. The futures closeout price in case of decrease is 96.06. I just made it red in step 4. So difference between futures price and futures closeout price in decrease, it's 96.06. That's the formula, difference between futures price and futures close price into spot 100 into contracts 90 into tick 12.5. This makes it 144,000. Important thing, it's a gain or a loss, will be added or deducted. Now, the strategy is buy now, sell later. In deposit, the strategy is buy now, sell later. Buy now, first one buy 94.78, sell later 96.06. Buy at 94.78, sell at 96.06. Buy at 94.78, sell at 96.06. It's a gain or a loss. Buy at 94.78, sell it higher 96.06. It's a gain. Gain will be added or deducted. Gain increases return. So you have return, gain increases return, add it. This makes it 515250. The proof that your working is correct. Both options increase decrease of FRA must be same, and both options increase decrease of futures must be same. Okay, and once you have done this, you just need to go and find the effective interest rate as follows. Net return or cost 515250 divided by borrowed or deposit amount 27 million into 12 months over time period of borrowing 5 months. This gives effective rate as 4.72%. Okay, so this ends futures. Okay, now comparing these two, the effective rate was 4.72 in FRA. Okay, in FRA it was 4.72, and sorry, in futures it's coming 4.58. The effective rate was 4.72 there in FRA, and in futures it was 4.58. So I have not performed options yet, but comparing these two, FRA is giving 4.72% effective rate, and this is giving, futures is giving 4.58. So in deposit, which is better, which is giving the highest rate? In borrowing, which is better, which gives the lowest percentage? But in deposit, we prefer the one which gives the highest percentage. So among these two, the percentage of effective rate of FRA is higher, therefore that is preferred, but we will finally decide when we complete options. Okay, you can copy this, and any queries please ask. Anjali, 3 by 12 is fixed in tick size because the contracts expire after every 3 months and it's a 1 year period. Ioni, the interest rates increase by 1.1 become 5.3 and decrease by 0.6 become 3.6. But you can't invest money at 5.3 and 3.6. You can invest at 30 basis points, 0.3% less. So 5.3 less 0.3, it's 5, and 3.6 less 0.3, it's 3.3. Yes, Muhtar. I told you yesterday as well, there is no fixed approach. You can follow exactly what examiner is doing, or you can follow my approach or XYZ, any approach, as long as your answers are the same. Afzal, if there is one case interest is increasing or decreasing, you should be happy. Why are you worried what to do? You should be happy. You just have to perform one working then. Afzal, I am not able to understand your last question. Shalima, yes, formulas need to be written. Bharati, in FRAs and futures, they give the same. No, Keshav, it's difference between March futures price and futures closeout price, which you have already computed in step 4. Now, Afzal, that's a very, what can I say, particular term about it. That is a question which means that the basic understanding of interest rate risk management is lacking. You're asking, do we have to perform futures when interest rate remains same? If interest rates remain same, there is no interest rate risk. Interest rate is the risk because interest rates keep on changing. If they are remaining same, then what is the risk? Why you need to hedge it? No technique would be used. So I don't know. Is that the question which you were asking, or I got it wrong? Bharti, we cannot tell you which questions to practice. Obviously, you should open the kit or the past papers and try to solve as many questions as possible. View the September webinar video, you will get one more question from my method. Okay, so in this particular question, I told you that whenever you start any interest rate risk management question, the first thing which you should do is to write these four things. Case of deposit or borrowing deposit, today's date, borrowing deposit date, till what date you're borrowing depositing, that's all will be given you just to copy paste. Now, the company was considering three techniques, FRAs, futures, options. So we need to recommend which is the best one. So obviously we will solve all and then decide. As far as FRA is concerned, the company's today's date is 1st October, plans to deposit on 31st Jan. 4 months, for 5 months, the relevant FRA is 4-9 5.02. Now you need to solve workings for FRA in both cases, increase, decrease. So increase by 1.1 for format is actual return on deposit amount into rate of interest becomes 5.3 less 30 basis points 5 into time period 5 over 12, 560 to 500. Loss due to or gain due to FRA, it's the difference between the market rate 5.3 and the locked rate into contract amount into time period over 12, 31 500. Since the rates increased by 1.1 became 5.3, but you locked at 5.02 is loss due to FRA. Loss decreases return deducted 531. But if it's decreased by 0.6%, actual return on deposit is the amount into rate. Decreased by 0.6 means 4.2 became 3.6, but less 30 basis points 3.3 into time period over 12. But then you locked rate at 3.6, they decrease, but you locked at 5.02 into amount into time period over 12. That's again because the rates are 3.6, they decrease, but you locked at 5.02. Gain increases return added. Proof is both give the same answer. Apply the effective rate formula. Net over amount into 12 over 5. When you went towards futures, there are 7 steps. Number of contracts is the amount over contract size, 500,000 into time period 5 months over 390 contracts. Basis risk is the spot 100 minus LIBOR 4.2 less futures price. We were planning to deposit on 31st January, but we took the very next future 30th March. So 94.78, 1.02. Unused basis, the basis risk 1.02 into extra months. From 31st January, you took a future of 31st March. 2 extra months, total months 1st October to 30th March, 6 months, 0.34. Find future closer price in both cases, increase and decrease. Increase by 1.1, so it's spot minus LIBOR, which becomes now 5.3. And spot minus LIBOR, decrease by 0.6 becomes 3.6. So it's 94.7, 96.4, less unused basis 0.34, 94.36, and 96.06. Tick size, contract size into 1 over 10,000 into 3 over 12. Okay, outcome of hedge in both cases, increase by 1.1, decrease by 0.6. So it's the format same, actual return on deposit and gain loss due to futures net return. Actual return on deposit is the amount 27 million dinars into rate of interest. If it's increased by 1.1 became 5.3 less 30 basis points 5% into time period over 12, 560 to 500. If decreased by 0.6, it becomes 3.6 less 0.3, 3.3% into 5 over 12. You got the return on deposit. Gain loss due to futures are the formula. Difference between futures price 94.78 and closeout price, which is 94.36 an increase and 96.06 an decrease, to spot into contracts and to tick. You got the answer, but it's gain or loss. It's buy now, sell later. Buy at 94.78, sell at 94.36 less. It's a loss. Loss reduces return deducted. And buy now 94.78, sell at 96.06 higher. It's a gain. Gain increases return added. The proof is that net answer should be same and effective interest rate. You then compute it. Okay. Makaiko, yes, it won't change. Now let's move to the final technique. That is interest rate options. Now again, the format of options needs to be designed first. In case of borrowing, take put option. In case of deposit, take call option. We will do that. But in options, you have to make two heads. Case one, increase LIBOR. In case two, decrease interbank rate. Okay, so you need to make two columns. The first is two columns, increase by 1.1, decrease by 0.6. Okay, now you need to make the format of options. The first step is exercise price of options, then future closer price from futures. So we write second, compare with future close out price it comes from future. Then third, exercise yes no, gain in basis points if yes. Gain in basis points if yes. Then total gain. Then it's actual cost of borrowing or return on deposit from futures. So you are doing a deposit case, so actual return on deposit from futures. Seventh, premium payable. This will give all of us the net cost or net return. And then finally, the eighth number comes, that is effective interest rate. Okay, so this is the format of options that you need to perform these 8 steps in both columns, increase, decrease. You need to write exercise price of option, compare with future closeout price from futures, then exercise yes, no, then gain in basis points if yes, then total gain, actual return on deposit, and then premium payable, and finally you get the net return. Now let's start. Exercise price of option. There are two exercise price or strike price mentioned. There are two exercise price or two strike price mentioned. You have to work on both. Today we will do one, and next we will do in the beginning of tomorrow's class. Okay, so exercise price. Here's the first exercise price, 94.25. In both cases, the exercise prices selected is 94.25. Compare with future closeout price from futures. Remember, in case of increase, the future closeout price was 94.36. Okay. And here, $96.06. Do you remember future closeout price from futures? We just computed in step 4, 94.36 in increase and 96.06 in decrease. So you got exercise price of option 94.25. I'm using the first exercise price. Future closeout price from futures is 94.36, 96.36. Exercise yes or no. You just have to write yes or no here. So what is the strategy? Buy now, sell later, or sell now, buy later? The strategy is buy now, sell later. So see, buy now, sell later. This is the strategy, buy now, sell later. So see, buy at 94.25, sell at 94.36. Buy at 94.25, sell at 94.36. Is it a yes? Buy at 94.25, sell at 94.36. Yes. In the right side case, buy at 94.25 and sell at 96.06. Yes, buy at 94.25, sell at 96.06. That's the strategy, buy now, sell later. Again, yes. Then you need to write gain in basis points if yes. The gain in basis points if yes. So the gain is 94.25, 94.36, 0.11. So 0.11 means 11 basis points. And here the gain in basis points is 94.25 minus 96.06, 1.81. That is 1.81%, so 181 basis points. I'm about to end this options as well, but please pay attention to these 4 steps. And if you have any questions, please ask. First thing, exercise price of option. I'm taking the first exercise price. Second will be discussed tomorrow, or you can try it yourself, but I will discuss it tomorrow's class starting. So exercise price is 94.25. The first exercise price 94.25. Futures closeout price from futures. Increase case was 94.36. Decrease case was 96.06. Yes, no. The strategy is buy now, sell later. Buy 94.25, sell at higher price in both cases. Yes, yes. Gain in basis points is yes. One is 0.11%, so 11 basis points. One is 1.81%, so 181 basis points. Total gain. Now, what is the formula of total gain? See, gain in basis points into number of contracts into tick. Gain in basis points into number of contracts into tick. So gain in basis points 11 into number of contracts 90 into tick 12.5. Is it okay? Open the detail. Gain in basis points 11 into number of contracts 90 into tick 12.5. And here, gain in basis points 181 into number of contracts 90 into tick 12.5. Right? Third last step. Actual return on deposit from futures. So it's written actual return on deposit from futures. See, actual return on deposit from futures. In case of increase, the actual return on deposit is 562,500. In case of increase, the actual return on deposit is 562,500. And in case of decrease, it's written above. Actual return on deposit is 371,250. It's written just above overview in the first line of futures. Actual return on deposit is 562,500, 372,250. Finally, the premium payable. Okay, what is the formula of premium payable? Premium rate into spot into number of contracts into tick. Premium rate into spot into number of contracts into tick. So premium into spot into number of contracts into tick. Which premium to take? Now at 94.25 exercise price, I'm using the first exercise price. There are a range of premiums, but remember, like yesterday, only one is relevant. Rule. In case of deposit, take call option. In case of deposit, take call option. So go to call option. So deposit case, go to call option. Both are cancelled. If call options, you see three premiums at the first strike price, first exercise price, 0.417, 0.545, 0.678. Remember, you need to take March ones. Remember, you need to take March ones because your borrowing or deposit was at 31st January. So you need to take the very next one, March. So premium is 0.4545. You will take call options because in deposit we take call option. The first price premium at call option is March 1, 0.545. So it's 0.545 into spot 100 into contracts 90 into tick 12.5. Okay, the premium will be 61313. Now one last question. Will premium be added or deducted? Okay, so you have actual return on deposit in step 6. You have actual return on deposit in step 6, and over that you have gain. You all know that gain increases return, so you need to add gain in return. Gain increases return, so you need to add gain. But premium has to be paid, so premium has to be paid. Premium payable will reduce return, therefore minus. Premium payable will reduce return. Gain will increase return, therefore I'm adding gain. But premium payable will reduce return, therefore I'm deducting. Net return. Add them all for net return. Five and 3652. Add them all. Five and 362. Again, the answer of both options is coming same, and finally you get the effective interest rate as net return 513562 divided by amount into 12 months over 5 months. So this makes it 4.56%. Although I can tell you one thing, in case of options, the answer of both increase decrease can be different. In futures, it can never be different. You have made a mistake if it's different in futures. In FRAs, it can never be different, but in options, it can be different. It can be same. Reason I will tell you tomorrow. Okay, so we have covered options, one portion as well. And if you have any question from options, you can ask. And we will not finish it. We will discuss the second exercise price because there are two exercise prices. Tomorrow's class at the beginning and then move towards the next topic. In the meantime, you can copy and leave. And how did you find the easy formats of interest rate futures and interest rate options? You can let me know in the feedback. Okay, thank you very much. Shalima, I'm using the first exercise price, 94.25. So the premium for 94.25 is 0.545. When we will use second exercise price, we will use the second premium, 0.098. No, Satya, sorry. Because in that case, the whole tomorrow session would pass in this. Because premium is in percentage, you need to compare in the numbers. Wami, you can check the Word file. The formula for total gain is gain in basis points into number of contracts into tick. Chioma, you need to contact ACCA. They will share the recording with you. Sayyid Mubin, 0.11 is the percentage. So 0.11 percentage means 11 basis points.